Deven Sangoi, CIO Equity at Aditya Birla Sun Life Insurance, joins us right now on the show. I don't remember the last time I spoke to you on any media platform, Deven. It's been a while that we've had your voice.
It's been a while.
Okay. So what have you been doing in this brief hiatus that you've had? What's been the analysis of what the markets are undergoing right now and what the near term could look like?
No, I think we are in the phase of consolidation. If you see the Nifty, more or less, it's been in the range of 3-4% movement. This is a phase of consolidation, but if you see the stock-specific movement continues to be there. So I think the markets are looking at surprise or the earning growth surprise, and they are fairly rational in rewarding where the performance has been above the market expectation.
So that's what's happening on the domestic front. What about the international front? Because I know you guys are putting in the money. You and mutual funds are the guys who are putting in the money. But what happens to international flows? They've been tepid, and if anything is to be believed, there are two big events that people are now worried about, at least people that I speak to, Deven. One is this Fed rate hike and maybe the series of hikes that could happen and the impact thereof. Two, if you believe that this whole taxation policy in the US has the power to pull in some money towards corporates in the US and thereby a natural flow out of EMs.
So if you look at right from the year, we have seen foreigners first time being net sellers.
Yes.
And it has never happened in last 8-9 years that foreigners been seller and the markets have gone up. So what we have seen is a vast change in the outlook, and I've been always optimistic. Optimistic as that the large flows of domestic, which were the investment flows, were moving only on a couple of asset class, either a fixed deposit, real estate, and gold. And equity ownership per household, despite of economic progress of last 15 years, has not been reaching the peak where we've seen. So it was a high time with gold out of favor, interest rates being low, and real estate returns obviously now pretty obvious that we haven't seen any return. People were left with no choice but to come to equity. And I think this story will continue for a meaningful length of time, and you'll see the domestic flow will be very good. As far as the foreign investors are concerned, we have seen that the market valuation as compared to any other emerging market or Asian market, they've been fairly high relative to what they've seen in last 10 years. So foreign investors have been a net sellers in India, and they've been buying either Chinese consumer, they've been buying Korean banks. So they've been buying things which are relatively cheaper with the same quality quotient. So I don't expect large inflows to come in India from foreigners. At the same time, the events what we are talking, I think the Fed rate hike has been talked. We've seen a very good recovery, and we will continue to see giving some kind of volatility, but I don't think so it's going to impact domestic flow. For domestic flow to impact, there has to be something, a Six Sigma event like a war with Pakistan or a China, or something politically going completely surprise to the market. So as of today, your fiscal is in good shape, political stability is there, reforms are happening. So I think everything good going. So we might go through a phase of consolidation, but overall, the long term looks pretty good.
So just one more question before Pradeep takes over. You don't foresee this US taxation policies changing in calendar year 18 to have any kind of material impact?
So it will have an impact on outflows on emerging market, maybe. But what I'm trying to say is that today the domestic flows are so strong. You have seen foreigners selling in billions of dollars, and yet nothing has happened to the market. So as long as this market is dependent on domestic flows, as long as domestic flow sustains with a foreign or any kind of event which makes a large correction across global market will correct, but it will be temporary.
Okay.
But are you worried about domestic bond yields going up? Because if you look at it, the private financials is the segment which has gained a share in the indices as well as in most of the portfolios. I'm sure the situation would be the same with in your case.
Sure. So I would say that we were expecting some kind of inflation pickup. We were expecting some kind of hiccups with GST. So what we have seen is, you've seen the inflation data came in yesterday, and I think inflation has really shot up. So there are components of inflation which have shot up. Again, GST is raising concern on the fiscal deficit. But overall, I am not too much concerned. The crude is one. We were expecting in the band of 60-65, but if it goes above 65 to 75 kind of band, and there are some macroeconomic pressure. I don't see the interest rate going up very fast. They have bottomed out. We have to see, and I'm very hopeful that as some of these proactive steps taken by the government, next year GST collection may surprise you, because they are not just trying to be setting up rules and seeing there are some flows and they are fast enough to correct it. So that adjustment process takes some time, but as you move and things settle down, and that we have seen with a lot of things, including Demon. People were very worried what will happen with Demon, but I think we have seen quite a stable economy and the recovery in the process. It's postponed the economic recovery, but I think we are seeing a lot of data points which are pointing towards a recovery beginning.
Okay. So say in 2018, do you really foresee a rate hike coming in from RBI, and will that affect the valuations in Indian markets?
So I would say the rate hike will depend on a couple of things. First, where the crude will be. Second, where the GST collection will be. As of today, I think this government is good enough in controlling the fiscal deficit, and we have seen time and time again. This year may be an aberration that you might have some slippages, but I think on the other side, you might see other, like you have ETF investment coming from government. The disinvestment side can, surprise you with HPCL going through, and the numbers can reach close to 80,000 to 1 lakh crore. So I think they've got a lot of levers in arm to, get the numbers right. So I won't be too worried as of today.
How have flows been for you, Deven, in the last, say, 3 odd months, and what are you doing with that money?
So we are getting ULIP flows, but for us, some of the old policies which are maturing, and we are seeing redemption, and that's the kind. So our AUM has been more or less stagnant on the equity side, but it's a mix changing for us. So I would say that we don't get too much of flows as much as mutual fund get, but we are getting a lot of long-term money. I think there's a good revival in ULIP sales. The rules which have changed in 2009 and 10 are very pro policy holders. So people are really, getting to see the benefit vis-a-vis what was pre-2009. And this is a long-term money, and I think that will sustain. As I said, that there are enough pockets of opportunity. So if I get too much of large money, maybe the people who get billions of dollars, they have an issue, but as long as I get few $100 million, I don't see an issue. I think we still pick and choose the ideas what we like.
So where are you picking and choosing? I'm not asking you to name stocks, obviously.
Sure, so we have picked up, one area we have picked up is mid-cap technology stocks. Wow. I think there's a lot of value, high dividend yield. One of my fund has almost, which is based on dividend yield investing, called Value Momentum. We've almost got 15% in mid-cap technology stocks. So these stocks have very low valuation, high dividend yield, and we can see this turnaround is happening. And some of the stocks will get into more than a double-digit earnings next year.
So the story is still pending, you would say, because the stocks
I won't say
I
won't say that it is a broad brush, but you need to pick and choose, and we can see when we pick and choose, we can see the earnings will rebound very strongly, because the business has been completely changed to what it was a couple of years back, and there is enough opportunity for all these companies.
And the market has not priced that in completely as yet.
I would say that market has been ignorant. We have seen in last 1 month, 1.5 months, some stocks have given almost 30 to 40% return. But I think if you see FY 18 and 19, where the earning growth rebounds pretty strongly, because this is just a turnaround, and as you see, then I think there's more scope of upside.
And what do you think is really driving it? I mean, the mid-caps doing much better than the last.
So again, see, some of these companies are in the range of $200 million to 800 million. They are quite small. They don't have baggage. They don't have so much of commoditized business. And if they had, they have been able to pare it down. So flexibility to change the business mix is quite, easily done as compared to the last guys. Second, they're focusing on the new technology, or they're focusing on the niche. And if you see, the digital spends have started moving up, and they've been moving up. So only the mix was dragging the overall sales. So we are seeing good cash flow, reasonable valuation, and growth coming back.
So you think it will sustain?
Yes.
Any other story that you have spotted?
So I think one area is we have seen retail is another area where I think organized to unorganized to organize is benefiting, and they are gaining market share. And we've seen every retail format, large, small, we've seen the market share gains happening and sort of a revival. So they've done a lot of work. So some of the retailers have significantly surprised on the earning front, and GST is also benefiting them.
So that was the story of 2017. Do you think it will work in 2018?
We see it continuing because if you see the per capita income growth, we haven't seen the economic growth. This is just an shift in market share plus shift in. So as you see increase in the per capita income, increase in the spending, you see the accelerated growth. And this is going to happen because the market share gains continue. And we have seen some jewelry retailer, we have seen the organized retailer, and that is surprising market quarter after quarter, and not by, is by a huge margin.
Okay, where are you not in line with what other large players would be doing? Mid-cap IT would be one, but I presume a lot of funds have now started getting in onto the act in mid-cap IT. So you were probably the earlier one. Some of the people have started coming in. So there is a train of thought which is constant there. Where is it that you are different from the rest of the market currently?
So I would
in
say
your thought,
that,
if not action.
No, I would say that in this market, I wouldn't say a sector specific. I think it's much become a bottom-up stock, and you can see as you go in 2018 calendar year, maybe the sector won't do, but specific stocks in the sector will start. So I would say it is going to be a market where, in our view, that bottom-up stock picking will continue, and that will differentiate. And I'll give you an example. For example, in oil and gas, the marketing companies have not been doing well, but the gas companies have really done well.
Yes.
So I can't say that oil and gas is a bad sector.
Do you like city gas distribution?
We own a city gas distribution, we own other transmission companies, but again, I am telling you, as the earning triggers happen and a lot of, so you need to be proactive in putting the portfolios to the right stock within the sector. I don't think so a sector approach is going to work today.
Okay. Great. Deven, thank you so much for taking the time out and joining us today, and look forward to having more on this forum as well.
Thanks. Have a nice day.
Thank you. Thank you, Deven.